All right, hi everyone. We're just gonna give it 30 seconds so everyone can log in and we'll get started. All right, so it looks like we reached a stable number. Okay, so hello everyone and welcome to the Florida Bar Tax Section CLE on Taxation of Subchapter C Corporations. Today's CLE is going to be approximately 2 hours and it's meant to allow for a deeper dive to assist those of you who are preparing for the board certification exam. So before we get started, we just have some quick housekeeping announcements. So registration is now open for our annual meeting in DC that's taking place April 22nd through the 26th. You can find more information about the meeting, including the very busy agenda and links to register on our website. If you missed our International Tax Conference and Boot Camp earlier this year, both courses are now available for purchase online. And please save the date for our next free CLE happening on May 7th from 12 to 1. The topic is going to be foreign investment in Florida real estate. We're now going to turn to Roy Myers, who'll say a few words on behalf of our Platinum B sponsor, Management Planning. Thanks very much for supporting the tax section. We really appreciate it. Roy, over to you.
Yeah, well, thank you, as always. And just tell you a little bit about ourselves and then go on with the agenda. For those of you that don't know MPI, Management Planning Incorporated, we just go by the MPI now. We are a business valuation firm. We are located up in New Jersey. We do lots of work in Florida and throughout the Southeast. Very, very active sponsor of the Florida Bar, the Florida Tax Section, Reptile, Heckerling, the Florida Tax Institute, the Florida Fellows. I know I'm leaving a few things out, but those are the highlights. The thrust of our business is business valuation. We value closely held companies for almost any purpose that you can think of. But our legacy type of business, what we're best known for, really would be our gift and estate type of work. We also do marital type of situations, litigation, mediation, commercial litigation support, general business valuation services, financial reporting. That would be mostly for accounting purposes, do some advisory work, fairness opinions, and everything in between. We have been around for 86 years, so we're not a newcomer to the block. We are independent. We own ourselves. We kind of thrive on that, or take pride of that. We are completely independent. We are not necessarily any industry specific. We are closely held business specific, and have a very good track record with the IRS. Virtually everything that we do gets accepted. If it doesn't get accepted, generally goes to no higher than appeals, and at the appeals level, generally very favorable settlements. That is a big, broad overview. You can find us on the internet at MPIVAL, like in valuation, MPIVAL.com. You go through there and you'll find me. Not sure why you want to look for me, but you'll find me there. And if anybody has any issues, anything that we can help you with, please feel free to either send an email, and I said you'll find it right on that website, or give us a call. With that said, I guess thank you, and it's time to go into business.
Thank you so much, Roy. All right, so today's CLE code is 8904. So again, 8904. We're going to put this number in the Q&A and also announce it again at the end of the presentation. The CLE is being recorded, and you'll be able to find it in about a week on our YouTube channel, along with all of our other free CLEs. If you have any questions during the presentation, please drop them in the Q&A, and we're going to answer them as we go along. So please don't wait until the end. Put your questions there, and we'll do our best to address all of them. Okay, so I'm pleased to introduce today's speaker, Adam Smith. Adam is the founder of BizTx Law, where he helps clients make well-informed strategic decisions that optimize outcomes. He advises clients at all stages of the business lifecycle, from startup to exit and beyond. Prior to starting his own law firm, Adam worked at the IRS Office of Chief Counsel, a Big Four accounting firm, a law firm, and the SEC. Adam also teaches at the Graduate Tax Program at UF. So without further ado, Adam, over to you.
Thank you, Bruno. Welcome, everybody. I'll give Roy one other shameless plug because I get to work with Roy fairly often in my practice, and and I'm also the director of sponsorship for the tax section, and we can't say enough about Roy. He's been a fantastic sponsor and supporter of the section, and we are going to, if you're going to be in DC, I'm arriving pretty late, but the first night, I believe it's Tuesday night, we are honoring Roy with a special event. So make sure you join. And with that, I'm going to go ahead and share my screen here. Let's see. Is that working?
Yep. Can you maybe make it bigger?
Brian.
Yeah.
There we go.
Perfect.
Better?
Yes.
Okay. All right. So this is a similar presentation to what I have given in the past. I gave this presentation last year, and the idea here is to give you a primer on Subchapter C. Basically, everything that you would learn topically in a typical first year LLM course, or JD corporate income tax course, both of which I taught at some point in my past. And so what we're going to do is we're going to walk through the life cycle of a corporation, of a C corporation, and discuss all of the different rules that apply. And don't feel bad if you're not able to pick up on every single rule. You're not. But the idea is at the end of this, you should have a framework in your mind of how to analyze an issue that comes up with Subchapter C, and also should be able to think about the benefits and detriments of choosing a C corporation as your entity classification for tax purposes versus, say, an S corporation or an LLC that's taxed as a partnership. Here's the roadmap that we're going to go through. As I said, takes you through the life cycle of a C corporation. So we'll start with the choice of entity, move into capital structure, then formation and capital contributions or contributions of property. Then as we get into the operating life cycle of the business, the distributions that you take as the corporation operates is going to earn income. What happens when you distribute that income out? What happens if you distribute property out? Then we'll deal with redemptions. That's where you're taking out a shareholder or having the corporation redeem their interests in a redemption distribution. Then corporate liquidations. And then finally get into both into the M&A concepts of taxable acquisitions and reorganizations. And I'll note here that there's an entire course on these two last bullet points and in most LLM programs. So it's going to be a very high level overview of those issues that arise and some things to think about. And then we can get into a little bit more of the details if time allows. But at least you'll get a broad understanding of the rules and what options there are available when you're looking at C corporations in an M&A context. All right, so choice of entity. This is the number one question that, in my experience as a tax lawyer, and also I practiced as a CPA before going to law school as a CPA, you're going to be asked, which is, okay, I want to start a business, or I'm thinking about acquiring a business. How should I structure that from a U.S. perspective? And so there are a lot of considerations here. What I'm going to try to do is highlight some of the key considerations and show you some of the benefits and detriments of each. And then we can touch a little bit on S corporations, but there's a whole nother course on S corporations. So I believe we already had that one. I can defer to that course as far as the details of how S corporations operate. All right. So C corporations, why you might choose a C corporation over some other entity. And before I get into this, I just want to clarify, because a lot of folks, including certainly clients and sometimes corporate lawyers and sometimes even tax lawyers, don't necessarily understand some critical distinctions. When we're talking about entity classification, that's the check the box rules and the classification mechanisms in Section 7701 of the Internal Revenue Code and Treasury Regulation 301-7701-1 through 3. Those are entity classifications. They are how the entity is taxed under the Internal Revenue Code. That is not the same thing as the legal choice of entity. In other words, you can have a limited liability company under state law that can elect to be classified as a corporation or perhaps as a partnership if it has more than one owner. That's by default. An LLC can also be a disregarded entity, doesn't exist for tax purposes, but does exist for legal purposes. Or if you choose to treat it as a corporation, it can be either a C corporation or an S corporation by virtue of filing an election under Subchapter S. Also note that that election under Subchapter S, the Form 2553, while the code and regs do treat that as an entity classification, as if you had filed an entity classification election, that in and of itself, an S election versus a C corporation status is not a classification, so to speak. Both of those are considered corporations. And that's important to note because the rules of Subchapter C generally apply to S corporations unless there's an S corporation rule in Subchapter S that overrides it. Okay, so that's the premise, the lay of the land, if you will. Why C corporations? Well, corporations in general provide pretty good asset protection, maybe more so than an LLC. For example, in Florida, LLCs generally have this charging order protection, which you may have heard of, but that only applies if it's a multi-member LLC. Effectively, you end up, I would say, almost in the same spot between a corporation and an LLC as far as asset protection, but there are some considerations with LLCs that could provide a better result for a limited liability company over a state law corporation. But we can talk a little bit more about that if you have questions. But you will have asset protection with a corporation. Double taxation, this is a detriment. Oops, get that back. Double taxation, this is what folks believe to be one of the largest detriments to having a C corporation structure, and that is that the corporation itself pays an income tax as at 21%, I believe in Florida. State income tax is 5.5%. So you're up around, 25 or so percent, 26%, at the corporation level. And then again, when the corporation distributes its earnings, the shareholder pays tax on that income. If it's a domestic corporation, most likely it's going to be at the qualified dividend income rate, usually 23.8%. That's a 20% maximum capital gain rate plus the 3.8% net investment income tax or Obamacare tax. Why you might choose a corporation from an M&A perspective or a capital raising perspective, a lot of venture capital firms tend to like corporate structures over partnership structures. And so that might be a benefit if you're looking to exit or your client's looking to exit in a venture capital setting or to raise capital in a venture capital setting. I will say, private equity firms generally tend to prefer partnership structures. They like to be able to pass through the deductions. So you don't have that corporate level taxation, which along with the corporate level taxation comes the inability to pass through deduction items. The deductions get hung up at the corporation level. So let's say an early stage company operates at a loss. That loss is going to be stuck at the C corporation level, and you won't be able to pass through the loss to yourself as the shareholder. One nice thing about C corporations as opposed to S corporations is their flexibility in the different types of classes of stock that you can issue. S corporations, as we'll discuss, have a single class of stock limitation. There's a rule that says you can only have a single class of stock. You can vary the voting rights, but you cannot vary the economic rights of an S corporation. So a lot of times, I don't know if any of you deal with real estate clients, for example, you'll have a promote or a pref sometimes where the money partner comes in, or the money equity investor comes in and says, I want, before anybody gets any return of the proceeds of this venture, I want to get my money back in an 8% return, and then you can pay yourselves as the entrepreneurs in the deal. You can't really do that with an S corporation. You can with a C corporation using preferred stock, and you can also do that with a partnership structure. And then the biggest one where I do a lot of work now is Section 1202 qualified small business stock. That requires that the stock be issued from a C corporation in an original issuance. And so there's a lot of planning around 1202 now. 1202, without getting into too much detail, provides for a 100% gain exclusion. It can be lower depending on when the stock was issued, but as of today, if the stock were issued today in a qualified small business corporation, you would have the potential to exclude 100% of the gain on the sale of those shares if you hold the stock for more than 5 years and the business is of a nature that meets certain requirements. It can't be, for example, accounting, law, unfortunately, engineering. It can't be based on the likeness of a person, and it also cannot be in the area of consulting or a brokerage. But generally speaking, for a lot of startups I work with, software companies, brick and mortar businesses, manufacturing, sales of products, apparel companies, I'm just naming some of the common ones I've worked with in the past, Section 1202 could apply, and there's a lot of planning around there. So C corporation is the only type of corporation you can use to issue qualified small business stock. S corporations, the benefit of the S corporation is you have pass-through taxation, meaning you have a single level of tax. As I mentioned, limited classes of stock. There's a one class requirement, but as I said, you can vary the voting rights. There is a limitation on the number of shareholders. It's 100, but there are some pretty lenient rules around the number of shareholders that you can get around that 100 shareholder limitation. The other hang up here is the types of shareholders. So a non-resident alien generally can't hold shares of an S corporation. There are some structuring alternatives to allow a foreign person to have a beneficial interest through an SBIT, electing small business trust, but you get a little bit more complicated with foreign people owning shares of S corporations. Generally doesn't work out all that well, and I've only implemented that in very limited situations with foreign people. Generally, as I said before, all these rules that we're going to talk about today apply to S corporations, contributions, distributions of property, so on and so forth, with certain exceptions. The biggest one is this flow-through taxation that we talked about a little bit earlier. S corporations also have similar asset protection. You can hear the big, and I guess I should have bolded this one in yellow, the big benefit of an S corporation for a lot of clients is the ability to save on self-employment tax. So if you want pass-through taxation, if you choose to go with the partnership entity classification and you are active in that partnership, 100% of the distributions from the partnership are subject to self-employment tax. Whereas if it is an S corporation, you need to pay yourself a reasonable salary, reasonable compensation, but anything above and beyond that as a distribution of the profits of the entity are not subject to self-employment tax. And the way that that works is you basically save about 7.65% up to a little over $160,000 of income. And then above and beyond that, it's about 3.9%. So there is some significant tax savings available on the employment tax side with S corporations. I will say you need to be mindful of the reasonable compensation standard. I've had a lot of clients get audited over that. You cannot generally use an S corporation and choose to not pay yourself any salary and take distributions. The IRS will challenge that. One detriment here compared to partnerships. So again, comparing to partnerships, which also have the pass-through taxation regime, is in partnership tax, if you have taken the course, the primer, and I think I taught that one 2 years ago, under 752 in subchapter K, you get basis for your share of partnership liabilities. So if the business entity is leveraged up, you can take deductions and losses up to the extent that there's debt involved at the partnership level. Whereas with S corporations, you do not receive basis for entity level debt, only shareholder debt. And then section 199 cap A, because it is flow through, there's a 20% deduction that is also limited to certain types of businesses. I won't get too deep into 199 cap A, but just know that S corporations and partnerships will avail you of the 199 cap A deduction if you meet the requirements. C corporations will not, because it's not a pass-through entity. Partnerships, you don't have complete limited liability with limited partnerships. There are some exceptions to that, like triple LPs, but generally a limited partnership has to have a general partner who is subject to unlimited liability. Again, you'll have the 199 cap A. And then one other thing with partnerships, these are partnerships in the sense that it's a state law partnership, is that you have the flexibility in allocating income and deduction items under subchapter K. Again, there's another course on that, so I won't go too deep into it, but just understand that example with the promote or the preferential rights to distributions and liquidations that we discussed before, you can handle those with a partnership, and you cannot very easily handle those with an S corporation. Finally, LLCs, as I said before, these are state law entities that can be treated a number of different ways for federal income tax and state tax purposes. Again, they generally have limited liability. I mentioned, here's the statute 605-05034, which is the limited charging order protection I mentioned before. So again, if it's a single member LLC, you're not going to get that protection. But if it's a multi-member LLC, what that does is it prevents a creditor, an outside creditor of the LLC, from being able to attach to the assets. What they get is the right of the members' interest in economic distributions from the entity, but not the ability to vote the interest or affect limited liability company actions. Sorry, finish this up. So you have the LLC is probably the entity of choice from a state law perspective for most practitioners in most situations. As I said before, you can choose various entity classifications for tax purposes. It can be disregarded if it's a single owner entity. If it's a multi-member LLC, it defaults to partnership taxation under subchapter K, or you can file an election in 8832 to make it a C corporation, or you could file a 2553 and elect to make it an S corporation. So you have all this flexibility with LLCs. And then again, here are the benefits of partnership tax. We talked about the flexibility of income and loss allocation. Remember that all the income would be subject to self-employment tax if you have somebody who's actively involved in the entity, in the management of the entity, and the operations of the entity. One thing that we'll see with corporations is it's not easy to move property in and out of the entity on a tax deferred basis, not necessarily as easy. So we'll get into section 351 and 311, but when you try to get into a tax deferred contribution or a tax deferred role in the M&A context, you need to be able to achieve 80% control under section 368C. And that's in the corporate setting. Section 721, which is the partnership, the corollary partnership rule, does not have a control requirement. So you could be a 5% owner of an interest in a partnership, contribute appreciated property, and not have to worry about gain recognition. You generally will be entitled to tax deferral on that. No gain associated with that recognized. LLCs have slightly less restrictive governance rules than do corporations. For example, board of director meetings, owners' rights, etc. This is just to say that if you are in a true state law corporation setting, be mindful of the differences in the rules for corporate governance between an LLC, which has substantially more flexibility, in corporations where you might have to have board approval for certain actions and so on and so forth. And then, of course, you have Section 199A again for pass-through treatment if it is a partnership, an LLC taxes a partnership or an S corporation. All right. I'll pause there real briefly in case anybody had any questions. Are we seeing any in the chat?
Sorry,
Yes,
no questions so far.
Okay. If you do, go ahead and throw something in the chat and we can address it. So where we get into the entity classification rules, as I mentioned, it's in 7701 and specifically in the regulations in 301, 7701, -2 and -3. These are what they refer to as the check the box rules. I'm sure you've heard about those before. So how do they work? Trying to just boil this down. A state law corporation is always a corporation. It's a per se corporation for federal income tax purposes. LLCs, as I mentioned, default to disregarded entity or partnership if they have more than one owner, DRE if they have one owner, but they can elect to be classified as corporations under 301, 7701-3, and you do that by filing a Form 8832, check the box election form. If you want to be an S corporation, you can file a 2553. Foreign entities are a little bit different. There's a list of by country of types of entities that are per se corporations. In other words, they're not called what the regs refer to as an eligible entity, an entity that can check the box and therefore are corporations per se. Can't change their classification, but many foreign entity types are eligible entities, which if you are involved in international tax, give you some great opportunities for planning and restructuring type transactions. And they can elect to be treated as DREs or partnerships if they have more than one owner, or disregarded entities. And we use that often in international tax planning to effectuate various transactions and achieve beneficial results. Okay, so that's choice of entity in a nutshell. The next part of this presentation addresses capital structure. So you decided, okay, I want to use a corporation as my entity and I want to be taxed under subchapter C. How do you decide how to capitalize your entity and what are the considerations? So really two discrete categories of investments or capital in corporations. One is a debt investment. Those are bonds, promissory notes, debentures, commercial paper, loans, etc. The second type is equity. So debt and equity, a lot of folks tend to view those as mutually exclusive. And I see that a lot in some of the 1202 analysis, because for you to qualify for 1202, it has to be equity or stock of a corporation. And there are a lot of different examples, and I'll give you a couple here that come up, which are considered hybrid instruments. They take some of the features of debt, some of the features of equity, and some other features that are more akin to contractual rights. A good example of that is a safe convertible debt, some preferred stock that has debt-like features. And if you really wanted to see an example, whether you qualify as stock, and we'll see why that's important later on in this presentation, but there's something called non-qualified preferred stock in 351G, and that takes you out of 351 non-recognition. Essentially, it is stock that has too many debt-like features. So mandatory calls, mandatory puts, features of that nature will bring you into 351G. And one good practice point here is sometimes you want to recognize gain or loss on a transaction. Let's say you have a built-in loss, you want to recognize the loss. So Section 351 is generally mandatory, but one way in planning you might be able to get out of the non-recognition rules of Section 351 is to instead issue 351G non-qualified preferred stock as you capitalize the corporation, which triggers loss recognition. We'll see in 351, you don't get to recognize a loss if it qualifies under 351. So I have used this as a planning technique before to trigger losses or to take a client out of Section 351 non-recognition. Okay, what are features of debt from a financial standpoint? So just taking a step back, understanding what is debt. Debt involves a debtor-creditor relationship. Again, we gave examples of bonds, promissory notes, debentures, et cetera. So what are the rights associated with that? One is the repayment of principal. I lend you $100. You're going to pay me back the $100 plus. Two, interest. Interest is effectively the cost or the price charged for the current use of money. So if I give you the $100 today, you're going to pay me a little bit for the ability to use that $100 and go invest today because you didn't have the money. That's one way of viewing interest from a financial perspective. What comprises interest? You have the risk-free rate, which is a proxy for the U.S. T-bill, or can be approximated with the U.S. T-bill rate. That's the rate of return with a government-backed debt security, and then a risk premium on the default risk. In other words, you're pricing out the risk that when I lend you the $100, what's the chance I'm not going to pay you back because I may not be as creditworthy or my business might fail, so on and so forth. And so interest can be thought of as a risk premium associated with the risk that the creditor, the person who is lending the money, isn't going to get repaid. And this can be in the form of a discount. So we used my $100 example. If I said we're going to have a $100 loan, but I'm only going to give you $90 right now because really there's a risk potential here that I'm not going to get repaid. So I'm going to give you $90. That is a discount, the $90. And we have rules in the Internal Revenue Code, the original issue discount rules, and we have a number of other rules in the 7,000s that deal with below market loans. And so the code deals with these interest rates, and these financial terms all tie into how the code deals with capital financing of corporations, as well as, in general, capital financing. Features of debt. So debt versus equity, what's the key feature? The key point is that debt holders have a limited upside potential. you only get back the principal plus the interest. And if the company does extraordinarily well, if you as the investor own pure debt in the company, your investment is pure debt, all you get is your $100 plus whatever interest rate you're charging, and the equity holders get the rest. On the balance sheet, very basic balance sheet here for those who have not taken accounting, assets equals liabilities plus owner's equity. This is where you're going to see the liabilities on the balance sheet. The debt financing is on the liability side. Equity is, of course, the flip side of that, which is why I said they are mutually exclusive. Equity is the next type of financing or capital structure that we will address here. So what are the features of equity? And again, there are hybrid instruments. So in the plain vanilla sense, equity gives the investor or shareholder unlimited upside rights, okay? Unlimited upside potential. Voting rights, so equity holders, unlike debt holders, have voting rights. They can elect board members, they can vote on extraordinary transactions, they are entitled to dividends if declared, if the equity participates in those dividends. There are situations where preferred stock doesn't participate, but for the most part, you're entitled to dividends, which are the distributions from the operations of the business. And then three, and the most important point here, is the share of the net assets upon liquidation. So the way that it works, and this is where bankruptcy law, creditor law comes into play, is if the corporation were to go bankrupt, it pays the debt holders first, and then anything that's left over goes to the equity holders based on their rights, which can be set out in a shareholder agreement. And the stock itself, stock certificates sometimes have the rights shown on there, but most of the time it's in a shareholder agreement. So items 2 and 3 here are really your participation in the growth or upside potential of the corporation, which is distinguished from the debt holder who does not participate in that upside potential. All right, we talked about unlimited upside potential. Here is, again, a picture of a balance sheet with the shareholders' equity highlighted. So again, you're owning the interest in the net assets of the company, assets minus liabilities. It's the basic financial equation for a balance sheet. And then this, I like this chart. I like to show this because sometimes students and folks do a little bit better with images, with illustrations. So remember, we talked about debt. The corporation's losing money. It still has to pay the debt holders back, but then you hit your interest rate, it's able to pay. And so here's your flat line, zero upside potential. As the corporation earns income, the debt holders get paid the same amount. And then at some point, the equity holders stand to earn full upside potential, whereas the debt holders continue to be limited in what they can earn if the corporation performs well. All right, this is my big warning that I always give out to clients and students alike, as well as colleagues. Always consider the client's business and financial objectives before addressing the tax issues. Too many times too often I get on a call with co-counsel, opposing counsel, corporate counsel, or a client, and they say, oh, I've got this great tax idea my CPA came up with, so on and so forth. And you start looking at it and you realize that, you can get a tax benefit, but it really turns the business deal upside down. And so a lot of practitioners will say, don't let the tax tail wag the business dog. Don't let the tail wag the dog. Always focus on the business objectives and then try to address the tax issues within the construct of the financial and business objectives of the client. Different businesses and legal issues will affect your decisions. For example, financial goals. I've seen this one before, where you have a private equity firm who comes in, and I've seen a practitioner try to recommend a debt investment to a private equity firm. And, high level, as we discussed, debt investments have limited upside potential. That's not really what a private equity firm is looking for. Same thing with a venture capitalist. So you may say, oh, debt sounds like a great idea here, but at the end of the day, again, focus on the business objectives. It's to have unlimited upside potential. Another aspect is securities law. Always be wary as a tax lawyer of securities law. I try to bring in a securities lawyer anytime there is a potential securities law issue, which is pretty much any partnership agreement, operating agreement, so on and so forth, where you're issuing interest in an entity. Securities law will come into play, whether you qualify for an exemption. So make sure you keep that in mind. Debtor-creditor law and bankruptcy law comes into play. You want protection. State corporate law, we discussed, sometimes there are corporate formalities that you have to abide by if you choose a corporate structure, whereas you may choose an LLC and elect to have that LLC taxed as a corporation, so that the governance laws under the Limited Liability Company Act would apply rather than the corporate laws that may require board votes and approval, so on and so forth. And then, of course, estate and trust law as well, and there are fiduciary duties associated with estate and trust law. What happens when you have an investment in a company and you're trying to decide whether it is stock or debt? Well, we have this case, Mixon versus the United States, out of the Fifth Circuit in 1972, which, by the way, applies to Florida under the Pritchard case. So this is binding precedent in our jurisdiction. It lists 13 factors. What it really boils down to is the participation in the growth of the company. And that's really, you can go through all of the factors, but at the end of the day, that's really what it's going to boil down to. All right. So now that you understand the features, what are the tax consequences of capitalizing with equity versus debt versus a hybrid instrument? For one, equity, regardless of whether you use debt or equity, there's not going to be gain or loss on the issuance of the instrument. So that's under Section 1032. And then Carnes Prime Fancy Food Limited is the case that says that a corporation recognizes no gain or loss when it borrows money. Non-recognition or recognition of boot received, that doesn't really come into play with debt, but suffice to say, and we're going to see 351, that generally there's non-recognition if we have control. And if you receive something other than stock back for your contribution to a corporation, there will be gain recognition to the extent of the gain realized up to the amount of the boot, the other property, non-stock in the corporation that you receive. And if that is true, then you would take a Section 1012 cost basis. If not, then 351 would give you, and 357 would give you a carryover basis. And then the last piece here is there are hybrid instruments. An example of that is a variable prepaid forward contract, which is treated as an open transaction, meaning the recognition or non-recognition event occurs at the conclusion of the transaction. Okay, income during life. If you have an equity investment, the corporation is taxed at the entity level. That's under Section 11, and the distributions are taxed as to if they're dividends, if they're out of earnings and profits, are taxed at 23.8%. So the investor, if it receives a dividend, or he receives a dividend, or she receives a dividend, that's going to be income to the investor. under Section 61 and 301c1, and that's measured in these rules here, 316 and 312. And again, dividends, if they are qualified, are taxed at the maximum long-term capital gain preferential rate. Debt, on the other hand, corporate debt, the corporation would be entitled to a deduction under Section 163A for payment of the interest to the debt holder or the creditor, which is going to be subject to a limitation under 163J. And the investor is going to pick up interest income, which is taxed at the highest marginal rate. And I see here, I forgot to update this. It is 37%, not 39.6%. And that's in 61A4. And then, of course, as I mentioned before, the return of the principal is not taxed. All right, so this is just a comparison. And I know I'm spending a lot of time on this part of the presentation, debt versus equity, entity classification, but these, to me, are the questions that clients most often ask. So we'll get into the nitty-gritty detail shortly, but this is the big picture piece of advice that a lot of clients are asking for from their tax lawyers. So this spreadsheet here demonstrates in numbers the benefits and detriments of each. A debt investment here. So I'll walk you through that. The corporation earned $200 of income. If it pays interest to the shareholder, it would get a $100 deduction at 21%. So the corporation has net income or taxable income of $100, $21 corporate tax liability, right? Then the shareholder receives the interest income. I do have the 37% correct here, pays $37 on that. And the total tax on the transaction at that point in time is $58 with a combined effective rate of 29%. If instead there was equity, the corporation has income again of 200. If it pays a dividend of 100, there's no deduction for dividends. So you still get taxed at 21%. That's $42 of tax at the corporate level. And then the shareholder receives that same $100 that we talked about with interest as dividend income. And that's going to be taxed at 23.8%. So bottom line is that the taxpayer there pays in total on all the income of the corporation 65.8% with an overall combined effective rate of 32.9%. You can see that the equity investment yields a higher tax rate overall. And so you could structure into debt to achieve some tax savings, but again, you're limiting your economic rights. And so don't let the tax tail wag the business dog. And we'll move on from there. Okay. Any questions about capital structure, the differences between debt and equity, and why it matters?
No questions so far.
Okay, great. Now we can get into sort of the meat and potatoes of subchapter C. All right, corporate formation and contributions. So when you form a corporation, or this also, to be clear, applies to midstream transfers after the corporation has been in existence, additional contributions of property, Section 351 is our governing provision. And what 351 says is that despite the fact that in general, a taxpayer recognizes gain or loss on a sale or exchange of property, and here there would be a contribution of property by the shareholder to the corporation, and the shareholder would receive in exchange for that contribution stock of the corporation back. So the general rule is, going back to your tax 1 class, is that all taxpayers recognize gain or loss on a sale or exchange of property unless the taxpayer can point to an exception in the code. 351 is one of those exceptions. And I mentioned 721 in partnership tax. 721 is another exception. I'll give a few more examples and you'll start to see a pattern here. 1031 exchanges are non-taxable exchanges. That's another exception to the rule. So you got 351, 721, 1031, 361. We're going to talk about reorganizations, 361, and so on and so forth. So you can see the pattern there. All of those provisions end in the number 1. Just fun patterns to keep in mind, maybe help you remember as a mnemonic device the non-recognition provisions in the code. What do you need to achieve non-recognition? So 1, it's 3 elements. 1, a transfer of property to a corporation. It cannot be services. So a lot of times when we're doing M&A transactions, we very clearly memorialize that the taxpayer or the contributor is not receiving any services in exchange for the stock, because to the extent that they're getting stock back for services, you're outside of 351 and you recognize ordinary income equal to the value of the stock received. 2, it has to be solely in exchange for stock. So if you get something back that is not stock in the corporation that you're transferring the property to, then you're going to recognize gain under 351B. And then I noted that 351G non-qualified preferred stock exception there. Stock that falls into that category is not going to qualify for non-recognition. And then 3, the big issue is section 368C control, which means that immediately after the transaction, the transferor's property own both at least 80% of the vote of the corporation and at least 80% of the value of each separate class of stock. So if you have multiple classes, you have to run the second test on each class of stock, and that's under Revenue Ruling 59-259. Now, going back to choice of entity, just kind of bringing that concept back, remember that Subchapter K in the partnership tax rules do not have a control requirement. So if you are doing an M&A transaction and as the seller or the buyer, there's an opportunity to have rollover equity. In other words, rather than cashing out your entire interest in the enterprise, taking back an interest in the buyer entity, a continuing interest in the underlying activities of the business. Section 721 is often the way that we get out of the control requirement, because when you have an acquiring corporation or you have an acquiring private equity backed company or private equity firm or venture capital firm, there is no way that you're going to own at least 80% after the transaction. The whole idea is that you're cashing out. So the way that we get into rollover, non-taxable treatment, tax deferred treatment is using a partnership structure underneath the buyer and issuing a partnership interest or a limited liability company membership interest in a 721 exchange. And then you can own 1% of the bigger acquiring company through this partnership interest, and you still achieve tax deferral. Hopefully, all of you are familiar with the step transaction doctrine. The step transaction doctrine generally has 4 tests. And what we're talking about here is, what do they mean by immediate 368C control, 80% of the voter value immediately after? If there are a series of transactions that occur over a period of time, maybe the transfers of property get to 70%, but then have the ability to acquire an additional 15% of the voting stock later on as part of the same deal. Or maybe there are other aspects to the transaction that can occur after, earnouts and things of that nature. Can you integrate, can you combine the 2 steps to hit your 80% control requirement so that the overall transaction is treated as one single integrated transaction to which Section 351 non-recognition applies? The 4 tests, or the binding commitment test, basically a contract in place that says this second step, the issuance of the additional 15%, will occur. period, end of story. The second test is an end result test or an intent-based test. Did the parties intend the end result to be that the transferor property would own at least 80% by vote and value? 3 is a but-for test, the mutual interdependence test. But for the fact that the company engaged in the first transaction or the parties engaged in the first transaction, would the companies have engaged in the latter transaction? In other words, are they reliant on each other? And then fourth, the alternative transaction. Was there another way to get to the same result without interjecting the intermediate step? And those are the 4 tests. Most courts in most scenarios focus on this first test, binding commitment. But always think about the step transaction doctrine. That's not just in 351 transactions. That's in pretty much any transaction you do. Okay, what happens if in a 351 transaction, the transferor property gets something other than stock in the transferee corporation back? Well, 351 still allows for non-recognition, but to the extent that that the transferor receives something other than the stock of the corporation, the transferor is deemed to have divested from the asset. In other words, sold the asset, and therefore has to pick up gain for the lesser of the gain realized or the boot received. So let's say I transfer a car to a corporation and I depreciated the car. And so I paid 100 for it and the car's basis was 50. I depreciated and taken $50 worth of deductions over the life of the car. And then I moved the car into my new Uber business corporation. I'm going to drive it as an Uber car, so I'm going to use it in a trader business. There's $50 of gain realized there. The asset was worth 100. I exchanged it for something else other than the car and got back stock, and I had a basis of 50. So amount realized minus adjusted basis, $50 of gain realized. If that's all I do and I control 100% of the corporation, then I don't recognize gain or loss. But let's say the corporation had already been operating and had some cash sitting in it, and I transfer the car into the corporation and get back some stock plus $10. Now I have gain realized of 50. I've gotten $10 back out of my investment. And so I got back something other than stock. And even though I control 100% of the corporation, I'm going to recognize $10 of the $50 of gain on that car. So that's how Section 351B operates. Now, if we had multiple assets, let's say I had 2 cars that had different fair market values. There's a revenue ruling, 6855, that says that we allocate the boot based on the relative fair market value of the property. So and the reason this is important is, let's say one of those cars I held for more than a year and the other one I didn't hold for more than a year. Okay? There's a rate difference there. The first car that I held for more than a year is going to be 1231 property, excuse me, and will result in long-term capital gain treatment. Whereas the second car wouldn't qualify as 1231 property because the definition of 1231 property requires that you hold the property for more than a year. And so that would be short-term gain. And short-term gain is taxed as ordinary income. So how do I determine the extent to which I pay long-term capital gain versus short-term capital gain? It's going to be based on the relative fair market value of those assets. All right. Section 351G, non-qualified preferred stock. I mentioned that before. That's always going to be treated as boot. So to the extent that you receive both stock of the corporation that is generally not 351G stock and some 351G stock, then you have to treat the 351G stock as boot, as though you received cash or some other property. How do you determine the character? Again, we talked about why it mattered. So again, here are your character provisions: ordinary income, section 1221, which is capital assets, and 1222. We talked about 1231. 1245 is your depreciation recapture for tangible personal property. 1250, there's unrecaptured 1250 gain, which is on real depreciable property, and then 1239. How do you allocate the different characters of income? Again, you're going to apply Revenue Ruling 6855. It's going to be based on the relative fair market value. And I gave you an example of the car. Think of what if we had the same thing, but one of the assets was land and the other one was a car. The land was not depreciable, and so that would have been a 1231 asset with no ordinary income. And the car, the depreciation recapture on the car is going to be 1245 recapture. And the allocation as to whether I'm going to have recapture ordinary income gain or long-term capital gain, in other words, 1231 gain that's treated as long-term capital gain, is going to be based on the relative fair market value of those assets. 1239 has an ordinary income recapture provision if there's a sale between a corporation and a more than 50% shareholder. It's a related party recharacterization rule, anti-avoidance rule. So all of these have to do with character of gain and the rate that's going to apply and how you deal with that in the context of a 351 transaction. Okay. Liabilities. How do we handle liabilities when, let's say, I transfer a building to a corporation and there's a mortgage loan with a mortgage on the building? So partnership tax has its own way of dealing with this in 752. But in corporate tax, 357 is the rule that applies. And the general rule under 357 is that if the corporation assumes a liability as part of my transfer of the property, so again, I'm transferring a building that has a mortgage loan with a mortgage attached to it, a lien or an interest in the property, and the corporation assumes that mortgage because it's going to own and operate the building, generally that liability doesn't create gain recognition. And the reason for this, if you go back into congressional intent in the legislative history, is 351 was there to encourage investments in corporate in businesses that operate in the corporate solution. And so Congress understood that debt financing is a big part of business and did not want to punish taxpayers for forming corporations and moving their businesses into a corporate solution by forcing gain recognition solely by virtue of the fact that there's debt financing involved. So keeping that in mind, Congress needed to come up with some limitations on the ability to not pay tax when liabilities are assumed by the corporation. And those are found in section 357B. Section 357B says, in B1, says, notwithstanding that liabilities are not treated as boot generally, if there's a federal income tax avoidance motive, or there's no bona fide business purpose, then all of the liabilities, and that's really important, all of them, not just a portion of them, all of them are treated as boot, which means you recognize gain to the full extent of the lesser of your realized gain or the amount of the liabilities. So staying out of tax avoidance, bona fide business, and focusing on having a bona fide business purpose is important when there are liabilities involved in a 351 transaction. And when you are documenting that as a lawyer, you want to make sure that you document that this was not a federal tax avoidance mechanism and there was a bona fide business purpose. Fairly easy to get around those exceptions to 357. Just be mindful of them and understand that they are out there. The big one that comes up is this third bullet point here. And this is the exception that you really have to be careful with when you're planning transactions. And I always go back to the CPA or the accountant and make sure that we document that there's been an analysis done under section 357C. So what does 357C say? 357C says that if the aggregate liabilities assumed by the corporation exceed the aggregate basis of the property transferred, then the transferor recognizes gain equal to the excess. Okay, so I'll break that down. And for those who remember Tax 1, you should remember a case called Tufts or Tufts gain. This is the concept. This is the Tufts concept. If the liabilities exceed the basis of the property, you're deemed to have realized an accession to wealth equal to that excess. So let's say I transfer a building that was depreciable. I paid 100 for it. I've depreciated it down to 50. So my basis is 50, but there's still an $80 liability. I put 20% down on the original purchase, as is often the case, right? I have an $80 liability outstanding that I still haven't paid back. My liabilities, my aggregate liabilities are 80. My basis is 50. I have $30 of section 357C gain. So you always want to look at the liabilities and make sure that if you're doing one of these transactions, that you don't have 357C exposure. Now.
Hi, Adam. So sorry. So before we move forward with 357, a question just came in about 351 and the control rules. So I'm just going to read it for you. The question says, let's see the following example for purposes of section 351. Corp A has 100 shares solely owned by individual B. Individual B wants the corporation to issue 100 more shares, total 200 shares. The idea to have more shares is to invite more investors to the business. Let's say that the new investors are going to contribute cash in exchange for the 100 new shares recently issued. Do we meet the control rule there? And how would be the taxation or non-recognition in this case?
Okay, so in that example, you don't need 351. This is a real technical point that I've gotten arguments with like heads of national tax practices at the Big Four. A transfer of cash in exchange for stock, you don't need 351 because there's not a transfer of property that would have a built-in gain. So you don't really need 351. I'll take that example one step further in a transaction that I'm working on with one of my good buddies at McDermott, opposite each other. But in our scenario, we do have a transfer of appreciated property, but my client isn't going to own, they're only going to own 10% of the combined entity after the contribution. So there's a rule and a revenue procedure out there that says that if you contribute cash that's at least 10% of your basis, then, I'm sorry, of the value of the then existing stock in the corporation, then the transfer of cash can be combined into that control group, that 368C control group. So take your same example with the investor who's going to get the additional 100 shares. But let's also say that B wants to put in appreciated property too at the same time. There's a rule that says that as long as your investor puts in an amount that's at least 10% of the value, then that can be treated as a transfer of property, be featured as part of the control group for your calculating your 80% control. So even though my client's only getting 10% of the value of the combined corporation, because the other investor is putting in enough and they own the remaining 90%, now we have 100% control. So hopefully that answers your question. All right.
Thank you.
Yep. Okay. Let's get back to 357C. And this is another great planning technique. So I said, be really careful here. We talked about the check the box rules, which are fantastic. We love using that for planning. But I've seen clients footfault here and cause gain recognition because they weren't paying attention. So when you check the box on an entity, let's say you have a disregarded entity and you file an 8832, then the entity becomes regarded. If you had intercompany liabilities and the corporation has the receivable, the owner of the corporation has a payable, and the payable springs to life when you check the box. In other words, now you have two separately regarded taxpayers. That's called a springing liability. And if those liabilities, if those intercompany balances exceed the aggregate basis of all of the assets of the company that you're checking the box on, you could have a 357C problem. It would cause gain recognition. And there are some ways to deal with this. One is you could have an additional contribution of cash to get the basis up or property. But two, and a lot of people, a lot of tax practitioners and academics disagree with these decisions, but there are two cases out there, Parachi and Lessinger, which in my view don't make entire logical sense, but they're out there, that say that you can, if a solvent transferor makes a promissory note to the corporation, then they can boost their, basis, so to speak, for purposes of 357C and avoid the gain. So all I would have to do there is issue a note to the corporation for an amount to make up the difference between my liabilities and my adjusted basis. And I should be able to rely on these cases to get outside of the gain recognition rule in 357C. I like to find better ways to do it than issuing a note because I don't agree with the reasoning of Parachi and Lessinger, but those cases are out there. One last note here. So that's 357C is if you contribute a receivable due from a corporation, there is a gain exclusion under the COD income rules. Some folks will say, well, now you've extinguished the debt for you're contributing debt, you're extinguishing the debt. There isn't that cancellation of indebtedness income. There is an exclusionary provision in 108E6 that gets you out of the cancellation of indebtedness rules when you contribute debt to a corporation, an intercompany debt. Okay, so we talked about 351 non-recognition. And again, we're trying to build this framework of how does the tax code operate? Well, the corollary to non-recognition in 351 and in 721 and in 1031 and in 361, in any of these non-recognition provisions in the code, is that you track the deferred gain by adjusting or not adjusting the basis of what you receive. So here you're going from one taxpayer, me, who had a car with a built-in gain of 50, remember, fair market value of 100, basis of 50. And we do a straight 351 exchange into a new corporation, no gain recognized. There's still $50 of built-in gain that hasn't been recognized. Well, how do we track that and ensure that at some point that appreciation is going to be taxed? The answer to the question is by virtue of the basis rules in 358 and 362. When a shareholder transfers property to a corporation in exchange for stock, they receive what's called an exchanged basis. These are defined in 7701 of the code, an exchanged basis in the stock. So it's the same basis that you had in the property that you gave up. In my example, 50. I didn't recognize any gain. I didn't get any money back. And I didn't have any amount treated as a dividend. So my basis in my stock is now 50. Meaning if I go and sell my corporate stock on the very next day, I pick up gain of $50. you can see that this basis rule ensures that my deferred gain ultimately gets taxed. The second, the second rule, so remember, in my example, we're going from me owning a car directly, a single shareholder, to me owning stock in a corporation that is itself a separate taxable entity, to two entities, two taxpayers, two taxable entities, me individually and then the corporation. So the corporation is going to take what's called a transferred basis in the property. The transferred basis is equal to the gain that, is equal to the basis that I had in the property immediately before the transaction. So in my example, I have a basis in my stock of 50. The corporation has a basis in the car of 50. The fair market value of my stock is 100 because the corporation owns one asset, a car worth $100. And the corporation's value, the value of my stock, is 100, the value of the car. We're assuming it didn't decline in value, but it has a different tax basis, 50. So what happens if the corporation then turns around and sells the car on day one? Again, the corporation is going to recognize $50 of gain. This preserves the taxability of the built-in gain on the property that I contributed. There is one exception to this rule in 362E, and that is when you contribute aggregate built-in loss assets. So in aggregate, all the assets, you combine the adjusted basis and the fair market value, and if there is an overall loss imported into the corporation, the code makes sure that we don't duplicate that loss, so that the loss isn't both in my stock basis and in the corporation's basis, inside basis in its property. And the way that the code deals with this is it reduces the basis in the property to the corporation to its fair market value, so that the loss sits in my stock, but not in the corporation's property. So if the corporation then sells the built-in loss property, no gain or loss recognized because the basis has been adjusted. There is an election in 362E2 Cap C to instead reduce the shareholder's stock basis by the same amount, in which case you're shifting the loss into the corporation, but the shareholder the shareholder loses that built-in loss. So because you're going from the moral of the story here is because you're going from one taxpayer to two taxpayers, if you have a built-in loss, this rule ensures that that loss sits only in one of the two taxpayers after you do the 351 transaction. And then there is a rule for how you allocate the loss for multiple properties here in 362E2 Cap B, which is in proportion to their relative built-in losses. Okay, so we just went through 351, which is a quarter of the entire LLM corporate income tax class. I'm going to summarize everything. So we do a good 351 exchange. The shareholder doesn't recognize gain or loss unless the aggregate liabilities exceed the basis, or the taxpayer, the shareholder receives something other than stock back, in which case the shareholder will recognize gain or loss equal to the lesser of the gain realized or the boot received. The corporation does not recognize gain or loss when it issues stock. But if it does distribute property, and we're going to get into distributions in a minute, if it does distribute appreciated property, let's say it had a golf cart, and instead of distributing the $30 cash in my prior example, it distributed to me a golf cart that had been fully depreciated, but it was worth $30, then the corporation itself would pick up a gain. We're going to talk about that distribution rule here in 311B. So typically what you'll see is cash coming out. You're not going to see appreciated property being distributed. But note that if the corporation distributes property as boot, non-cash property as boot, and there's built-in gain, then the corporation is also going to recognize gain on the distribution. The basis rules track and maintain the deferred gain. So the shareholder gets what's called an exchange basis, generally equal to the basis of the property that they transferred into the corporation, adjusted for any gain recognized in liabilities that are transferred. And the corporation is going to take a transferred basis. And remember 362E, if there's an aggregate built-in loss, then we have the rules that we talked about earlier. The other important concept here is holding period. Holding period determines whether you achieve 1231 status of the property. So you get that, I call it the gold standard. You get long-term capital gain rates on any gain for 1231 property and ordinary deductions for losses. That's 1231 property is real or depreciable property held in a trade or business and used in that trade or business held for more than 1 year. If the shareholder transfers property that satisfies that requirement, it's 1231 property, or it's a capital asset. This should say 1221. 1221 is the definition of capital asset. Then the shareholder gets to tack on the holding period that the shareholder had in the property. So now, if I held my car for more than a year, it would be 1231 property. My stock would have a long-term holding period. I will be treated as having held my stock for more than a year. My holding period for the stock, even though it was just issued, includes the holding period of the property transferred. And then, but that's only true if what I transferred was a 1231 asset or a 1221 capital asset. The corporation always gets a tax holding period in the property. And the reason is that the property itself is going to be directly owned by the corporation. And so the nature or character of that property is inherently going to be the same. Whereas with the shareholder, you're getting back stock and you want to achieve the appropriate holding period based on what has been transferred into the corporation. Okay, distributions. So, yeah.
Hi. So another question just came in and it relates to the previous question, the contribution of cash. It says the former shareholder prior to the prior transaction own 100% of the shares. After the transaction of contribution of cash in exchange of the new shares, the former shareholder now owns 50% of the shares. Basically, the shareholder got diluted. Can it be argued that there is a deemed sale of shares and therefore a taxation event of such shareholder, given then priorly he had the 100% of the shares and now he has only the 50%?
The answer is not if money or property doesn't go back out to that prior shareholder. So you wouldn't have, as long as there's no distribution out of the corporation or deemed distribution out. So if immediately after the prior shareholder ends up with $50, then yeah, you have a deemed, it's just as if the investor had paid $50 for the shares, right? Plus whatever contribution the investor made in exchange for the stock. So it's sort of a bifurcated transaction. You have to step back and look at the transaction, but I think the point that you're getting at is, yes, if there's a contribution by an investor, and at the end of the day, and we can talk about this is under sort of step transaction principles. If you look at the starting point and the ending point, and it looks like the former shareholder cashed out in some way, shape, or form, then absolutely you could have a deemed distribution or a deemed sale. Most likely it would be treated as a deemed sale to the extent that the shareholder receives cash in exchange for the dilution of his interest. Okay. Everybody good on that? You can email me later. I'm happy to hop on the phone or answer emails on that point, whoever had that question. So. Okay, distributions. So now in our life cycle, we've been operating, the corporation starts earning money, earning income, and now we want to produce returns for our equity investors who own stock in the corporation. How does that work under Subchapter C? So we have a three-tier system in Subchapter C. And I like to think of these concepts in principle. The way that our system works in Section 301 is it says, first, we treat it as a return on the investment to the extent that there were earnings in the corporation. So if you practice in international tax, you may have seen other taxing jurisdictions, I think Canada is one of them, where you can actually dictate whether the distribution is your original investment or a return on your investment. In the US system, the first tier is always treated as a dividend and taxable to the extent that the corporation has this concept of earnings and profits. Think of it as the actual cash, without regard to whether it's taxable, cash earnings. So tax-exempt income goes into earnings and profits, even though it's not taxable. It's the real economic ability of the corporation to return earnings of the corporation to its investors. Okay, I put $100 in, or I put my car in to my corporation, and remember my basis was 50 in the car. My stock basis is 50. I run my Uber business and I net profit of 10 my first year, and I distribute $10 to myself at the end of the first year. That $10 is going to be treated as a dividend because I have $10 of earnings and profits. Okay. The second tier, once I burn through my earnings and profits, is treated as a return of my investment. So first one is a return on my investment, which is taxable as a dividend. The second tier is a return of my investment, which is a non-taxable return of my basis to the extent that I have basis, and that's 301(c)(2). And then 3 is treated as a divestment or a taking of gain. The remainder, anything above my earnings and profits and my basis, is taxable gain under 301(c)(3). It's treated as though I sold or exchanged my stock for that amount. We're going to talk in a minute about redemption distributions. Those are treated differently. But your basic rule, and when we get into 302, you'll see if it doesn't qualify under 302, it sends you back to 301. This is your basic treatment. So again, definition of a dividend is a distribution of property, including money, out of the accumulated earnings and profits or current earnings and profits, regardless of the lack of or deficit of accumulated earnings and profits. The second part, I know it sounds verbose, but the idea here is that you accumulate earnings and profits over time through the close of the previous taxable year. That's your total earnings and profits. So think about, if any of you are accountants, closing out everything to retained earnings in that entry that you make, the accounting entry that you make at year end. I make my $10 in year one, I close my books, I now have a value of $110 sitting in the corporation, the 100 car that I put in plus the $10 that I earned, and I don't make a distribution. I now have accumulated earnings and profits of 10. So next year, if I make a distribution and that's all I have is the $10, that's going to be out of accumulated earnings and profits. Let's say, however, we're in the startup phase and I have an accumulated loss for my first year. Let's say I lose $10. I have a $10 loss my first year. And then in the second year, I do better and my company earns $20. So overall, before year end, if you were to combine those two, it would net to 10, right? The 20 positive and the negative 10 would net to 10. Or let's say, a better example, let's say I lost 10 my first year and earned 10 in my second year. And at the end of my second year, I make a $10 distribution. Well, if you were to combine the two, I had zero earnings and profits. But because I had $10 in the current year, I have a $10 nimble dividend that year. It's called a nimble dividend. I actually pick up dividend income even though I had a deficit in accumulated, or potentially a deficit or zero accumulated earnings and profits. But so you go first out of the current year earnings, and then if necessary, then you can go back to accumulated earnings and profits. It's a really important rule that a lot of people get hung up on, but it's very important to know that you could have a dividend even if overall historically you operated at a loss in earnings and profits or an earnings and profits deficit. Constructive dividends, I think we talked about a constructive sale or a constructive distribution with that question. Constructive dividends come up a lot in these small, closely held corporations, and they come up when the corporation pays personal expenses or confers an economic benefit to the shareholder without the expectation of repayment. Think about a small corporation that has, since we're in Florida and I'm a Panthers fan, Panthers hockey tickets, and I have the corporation purchase those season tickets, and I use them to take my kids to all the games. I don't bring a single business associate. I don't bring a single client to a single game the entire year. The value of those tickets is really an economic benefit that the corporation conferred on me. It was a personal expense, and that would be treated as a dividend. Okay, so that's the concept of constructive dividends, and they can come in all ways, shapes, and forms, but that's a great example. We just talked about earnings and profits and how you calculate them. It's very, very complicated, probably beyond the scope of this course. But with that said, I'll just give you the high level of make sure you look at the 316 regulations. If you have earnings and profits at the close of the year, and without regard to the earnings and profits that existed at the time of the distribution, then the distribution, where you take it out of, think of keeping this accumulation of value. First, it comes out of the current year earnings and profits, as we said, first in, first out method, right? Then you look to the accumulated earnings and profits. And this rule that we're talking about here is how you get to the nimble dividend that we discussed earlier. So the rule is in 1.316-2A and in 316A. It's an ordering rule that forces you to pick up dividend income, even if you had an accumulated deficit for prior taxable years. And then how do you calculate earnings and profits? I said before, it's an economic measure of the corporation's ability to pay out distributions as a return on the shareholder's investment. It's an economic concept. So the way that you compute it is you start with taxable income, and then you add back non-taxable but economic items, and you reduce for non-economic items like tax depreciation. So I gave the example of tax-exempt interest income, right? Tax-exempt interest income increases earnings and profits, even though it is not taxable. That would be an add back to get to your E&P number. So you start at taxable income and you make adjustments for economic type items and non-economic items that are included in your taxable income calculation. This provides you with a step process. Again, so you're going to start with taxable income, adjust for economic items that are not included in taxable income. I use tax-exempt interest, life insurance proceeds are some examples. Adjust for deductions that do not represent economic outflows. A good example of that is the dividends received deduction in Section 243. You get it under certain ownership structures. I know dividends aren't normally deductible, but if you have certain ownership thresholds, there is a dividends received deduction for certain corporate tiered ownership structures and subsidiaries who pay dividends up to their parent. 243, You can look at that, but that's going to be an adjustment because it's a non-economic outflow. Then you adjust for economic expenses that are not allowed as deductions. So federal income tax reduces your earnings and profits. Why? Obviously, federal income tax is not deductible, right? However, it does reduce the corporation's ability to pay you money that it made during the year. So the corporation pays its 21%. Those dollars are no longer available for a distribution to the shareholders. So it reduces earnings and profits. We talked about reasonable compensation. So if that's disallowed as a deduction, then you can add it back because it was an economic outflow, disallowed capital losses, fines and penalties, you name it, the list goes on. Again, the concept of getting at real economic ability to pay out the earnings of the company. And then you adjust for timing differences for, I mentioned accelerated depreciation, capitalizable costs, 263 Cap A, inventory, unicap rules, and then NOL carryovers. Deductions you get for net operating losses obviously are non-economic. They are the economics of the loss occurred in a prior year. Okay, so I'm going to try to keep going here. We got 20 minutes left. Distribution analysis. So one, the amount of the distribution is equal to the fair market value of the property distributed, net of the debt. Step two, you're going to look at the source. We just talked about the earnings and profits. Three, I mentioned section 311. If there is a distribution of appreciated property, then the corporation itself will recognize gain, which will increase earnings and profits and complicate your earnings and profits calculation. But understand that when a corporation makes a distribution of appreciated property, there is gain recognition, and that will result in an earnings and profits increase, which therefore increases the ability to pay out a dividend. So it increases the likelihood that you have dividend treatment. Then you adjust your current earnings and profits for that gain I mentioned, and then reduce for the distribution. And then at the end of the day, what does the shareholder take as the fair market value and property that's been distributed? It's the fair market value, takes as a basis in the property, the fair market value of the property distributed. Why? Because the gain already gets picked up under section 311. All right, redemptions. So redemptions are, in the broadest sense, they are true divestments of a stockholder or shareholder's interest in the corporation. It is a distribution that represents a true divestment from the corporation. How do the tax rules work? So the definition is in 317B. The corporation acquires its stock from the shareholder in exchange for property, whether or not such stock so acquired is canceled, retired, or held in treasury. The corporation buys the stock back from a shareholder. What's the tax treatment? So if you meet one of the tests in section 302, it takes you outside of section 301, which is dividend income, and puts you into sale or exchange treatment. The difference being that sale or exchange treatment allows you to offset the gain with your basis in your stock, whereas a dividend is taxed in gross. There's no reduction for your basis. It's all taxable. Okay. The principle, as I said, is a focus on a true divestment rather than an extraction of the profits or a partial return of the investment. And again, your analysis, we're going to look to section 302. Section 302B specifically has a set number of tests. If you meet one of those tests, then you treat it as a sale, the transaction as a sale or exchange of your shares. If not, section 302D sends you back to section 301, and we're back in the rules that we just discussed. That's your analysis. Section 302B test. One, if it's This is the one that we don't like to rely on. The first one, 302B1, not essentially equivalent to a dividend. I'll talk a little bit more about that. 2 is the one that we like to rely on because it is mechanical and gives you numbers and quantitative analysis. And that is substantially disproportionate with respect to the shareholder, the safe harbor mechanical test. 3 is a complete termination of the shareholder's interest. If I'm fully getting rid of all of my shares, 302B3 says we get to treat that as a sale or exchange. Makes sense. It's a true divestment. I no longer own the shares. The rules that come into play here are the related party constructive ownership rules, where you have family members or related corporations or related entities, and you'll have to look to those relationships to determine whether you've truly terminated your interest in the corporation. So, for example, if I sell all my shares back to the corporation, but my wife still owns the remaining 100%, she and I are treated as the same shareholder for purposes of this test, absent an election, and therefore I have not terminated my interest in the corporation. The fourth test is a partial liquidation. That's where there's a divestment from a line of business of the corporation. And then 5, we won't really talk about, but there are redemptions by certain regulated investment companies that will qualify. I mentioned attribution. Section 318 attribution rules apply, especially for this termination of interest test. But there is a waiver of those attribution rules that you can elect into to avoid the attribution and therefore treat the transaction as a sale or exchange or a complete termination of my interest. And then remember that, that step transaction doctrine, 302B2 Cap D, actually statutorily applies this to the substantially disproportionate test. Complete termination. I'm going to go through these rather quickly so we can move on. 2 functions to treating a redemption and complete liquidation of shareholders' interest. One, one, it permits the redemption of non-voting stock to qualify for capital gain treatment without having the vague, not essentially equivalent to a dividend, which is a facts and circumstances test apply. And 2, if all the stock owned by a shareholder is redeemed, then you can waive the family attribution rules under 302C and elect into treatment as a complete termination. Again, 302B2, there's a series of distributions that are pursuant to a plan can qualify. And here's some information about how the waiver of family attribution actually works. Substantially disproportionate. So this is that mechanical test. This is our sort of test that we like to focus on. 1, it's substantially disproportionate if immediately after the distributions, and both of these have to be true, by the way, the shareholder owns less than 50% of the total combined voting power of all classes. So if you own 50% or more of the corporation after the distribution, you are out of this test because you have to meet both of these. And then 2, if the shareholder loses more than 80% of his voting power. So this is a relative calculation where you look at what the voting power was before, what the voting power is after, and if the loss of voting power is more than 80%, then and the shareholder owns less than 50% after the distribution, you are inside 302B2. It's a numbers game. It's fairly easy to apply once you figure out the mechanics. And then, of course, again, the attribution rules apply to aggregate family members' ownership. There's no waiver of, I don't think you can waive family attribution for this purpose. Not essentially equivalent to a dividend. So now we're outside of that mechanical test. We're relying on a facts and circumstances test based on revenue rulings. The case law says there must be a meaningful reduction in the shareholders' proportionate interest in the corporation. And the focus here is on control. Can you control the corporate actions? So there are some examples. If the reduction results in a deadlock with one other related party, that has been held to equate to a loss of control, an effective loss of control. If you are already a minority shareholder, but you could have combined with another minority shareholder to affect corporate actions, and you lose that ability, there's a revenue ruling out, 2 revenue rulings out there that say that that would be an effective loss of control and would not essentially be a dividend. And then 3, if you retain more than 50% of the voting control, you're not going to qualify here for either of these because the focus really is on control. And then if there's non-voting stock, there's some other case law that'll apply, focusing on the economics and so on and so forth. You're right to the economics of the corporation, earnings and profits, assets and liquidation, preferred stock versus common stock, and this hypothetical dividend analysis. The courts will sometimes look at what a shareholder would have received if it was a common stock shareholder. In other words, like a hypothetical dividend type analysis. Partial liquidations. So what we're looking at here is a general contraction of the corporation's business. Think of, you have 2 lines of business. I had as a client L Brands a long time ago. They had Victoria's Secret and Bath and Body Works, and if you were to distribute out all of the assets related to one of those 2 lines of businesses, right, to the shareholders, that could, in full exchange of their shares, that could, for example, be considered a partial liquidation. So you're really like splitting up the business, and there are other rules in 355 where that might be a non-taxable corporate division, a spin-off, split up, or split off, or split up. We'll talk about that in a minute, but that's what a partial liquidation is. And it's limited to non-corporate shareholders. So that's something to be mindful of. Um, 302B4, they're again getting into the contraction rules. I'll leave this for your reading pleasure later so that we can move on. Be aware of section 304. That's when there are 2 relationships that can cause treatment where you actually have to test for dividend equivalency. That's brother-sister relationship. So parent owns 2 corporations, sells one corporation subsidiary to the other corporation. That's going to be tested for dividend equivalency. The same thing is true with a parent-subsidiary relationship when the subsidiary acquires the stock of the parent, also known as hook stock. And there's a full analysis that goes along with 304. Liquidations. All right. Try to speed things up here. 2 types of liquidations. A parent corporation and its more than 80% controlled subsidiary is a non-taxable liquidation or non-recognition event. And if you have an individual shareholder or a less than 80% corporate shareholder, so a minority shareholder, that is treated as a taxable liquidation. So one being taxable, a 100% owned subsidiary liquidates into its parent. That's a non-taxable exchange, tax deferred. And all of the similar rules that we discussed apply with the carryover of basis, tax attributes, so on and so forth. Neither the parent nor the subsidiary nor the shareholders recognize gain or loss in that scenario. I think that's all we need to say about liquidations. There are obviously a lot of other rules that come into play to analyze, but just know that if you have a more than at least 80% controlled subsidiary, you would be in the tax deferred non-recognition transaction. If it's an individual or a less than 80% corporate shareholder who is that the corporation is liquidating into, that is a taxable exchange, fully taxable. Consequences. So again, I said, with a 332, 337 parent subsidiary liquidation, there's non-recognition, there's a carryover of attributes, but note that if that's true, and you also have a minority shareholder, so let's say you have an 81% parent corporation, and then an individual who owns 19%, that individual is going to be treated as having received a taxable liquidating distribution. There's a carryover basis of assets, tax attributes, carryover, so on and so forth. And I will mention that 332 and 337, though statutorily are mandatory, there are some opportunities for planning into this using what they call granite trust planning, where you sell or gift a sufficient number of shares to fall below the 80% threshold so that you can recognize a loss. This is similar to the example that I gave with 351G, intentionally triggering gain or loss recognition so that you can recognize the loss. Same idea with granite trust planning and liquidations. Taxable acquisitions, coming to the end of the presentation. So again, I mentioned these are going to be really high level because this is a whole separate course. Taxable acquisitions, key considerations, you're going to want to think about stock versus asset deals. The seller wants to maximize the amount of gain that's treated as long-term capital gain rather than ordinary income. The way to do that is through a stock purchase. The buyer wants to obtain a high basis in the assets that it's acquiring of the corporation, particularly with inventory and depreciable property and things of that nature, where it can recover the cost quickly. So a buyer typically will prefer an asset purchase from a tax perspective. Asset sales, very simple. Corporation recognizes gain or loss on the sale of each asset. And it would be the same result as if the corporation had liquidated first and then sold all the assets. But you would have, with the liquidation concepts apply. With a taxable asset acquisition, the seller has to determine the gain or loss with respect to each asset. And so we have this purchase price allocation in section 1060, which requires the buyer and seller to agree to a purchase price, and you stipulate that. There's a form that you file. I believe it's 89. Anyway, I forgot the form number, 8594, I think, something like that. What this does is, if there's an agreement between the buyer and seller, the IRS will generally respect it unless it is manifestly unreasonable. And that allocation will affect how much gain or loss the seller picks up in terms of long-term capital gain versus ordinary income. It's called the residual method. Basically, you allocate to the assets, to the most liquid assets first, and then to the least liquid assets, and everything, the residual amount goes to goodwill and going concern value. It's set up by category. There are different categories of assets. There is an election available under section 338 if there is a stock sale for legal purposes to treat the sale as an asset sale. It's a joint election under 338H10. Both the buyer and seller have to make it. It's limited to certain circumstances where you have a member of a consolidated or affiliated group that's being sold, or in the context of an S corporation. These elections are also available for S corporations. This avoids the shareholder level tax, and then you have a deemed asset sale. Talked about this 1060 allocation being the residual method. 8594, there's the form. For some reason, I couldn't remember that. Here are your 7 categories of assets. You'll see they line up with in level of liquidity, and this is how you make the allocation on the 8594. Pay attention to intangible assets. The TCJA made an adjustment to certain IP that could result in ordinary income if you're not careful. So just be mindful of that. And then finally, reorganizations with 2 minutes left. All right. Policy of reorganizations. So all of this, I'm going to bring this back to sort of the very beginning of the presentation to help wrap this up. The whole construct behind 351, 361, 1031, all these non-recognition provisions, including 361, which is the operative provision in the reorganization rules, is that there's a continuation of investment in the underlying assets. And so that's what reorganizations look to. And you'll see there are similar control requirements in many of these. The general tax consequences, if you qualify, non-recognition of gain or loss and deferral of gain or loss, carryover basis, tax holding period, and carryover of tax attributes. These are common in a lot of these non-recognition transactions. Different types of reorganizations. You have the type A, statutory merger, type B, stock for stock exchange, type C is an asset reorganization. Within there, you have forward triangular mergers, reverse triangular mergers. Then you have the type D acquisitive reorganizations, which is an asset reorganization, usually in an internal restructuring where you have the same ultimate parent. Otherwise, you're usually in the type C reorganization. Then E reorganizations are any type of recapitalization. F reorganizations is just a mere change in identity, form, or place of organization. And then a G is a reorganization in bankruptcy. And just to conclude on this, since we're at the hour, here are the requirements. You can see that the consideration or the control requirement differs for each of them. So for an A, it's 40% of stock by vote has to be used as a consideration. B, only voting stock. C, only voting stock, but you can have up to 20% boot, meaning non-stock consideration. D, substantially all the assets. You can have what's called a cash D, meaning you can have 100% boot, 100% boot here. And then recaps, bonds for stock, stock for bonds, common for preferred, voting for non-voting, etc. And then a type F is basically you're creating a new legal entity for the same corporation that's going to continue on. And that is everything I have for this presentation. 201. Sorry, I didn't leave much time for questions, but I'll stay on.
Thank you so much, Adam. There are no questions pending right now. I don't know if anybody that's still on wants to ask anything. Okay, I'm not seeing anything. So thank you, everybody, for attending. Once again, the CLE code for today is 8904, 8904. Thank you very much, Adam, for this great presentation. Very insightful. We really appreciate your time.
My pleasure. And you all can email me. Oh, is there a question?
Somebody just says conversion of entities taxation, but this is not quite a question, so maybe it's going to be taken offline.
Conversion of entity. Oh, you mean from like an LLC? I don't know. They can email me. Do you mean from a conversion from another jurisdiction or an LLC to a corporation? I'm not sure what you're asking, but it depends on the context.
Okay, so with that, we are a bit over. So again, thank you very much, Adam. We really appreciate your insights. So thanks, everyone.
And thanks again, Roy, for your sponsorship of this and the tax section. We appreciate it.
You're welcome.
See you in DC.
Yep, absolutely.
I may not, my flight's getting in really late, so I may not be there.
Well, you'll be there in spirit the first day.
All right. Have a great day, everybody.
All right. Bye, everyone.
Bye.